Yeah, so we wanted to target consumers that were otherwise unbankable or underbanked by the existing ecosystem. Now, when we say unbanked or underbanked, we don't just mean segments of the population that just don't have a lot of earning capabilities. One of the big insights that we have learned is that financial stress does not discriminate. You can
Hmm.
be a millionaire in New York or San Francisco and still be under severe financial stress, and you could still be severely underbanked. You may have a very high earning capability, but there may be something in your past that is just not congruent with how a bank underwrites a credit product or investing product, or how they holistically look at you.
Welcome to the Tearsheet podcast. I'm Zack Miller. We're kicking off a new series here on the podcast called Blocks. In this series, we're turning to entrepreneurs and professionals who are building the next generation of financial services leaders to understand better how they did it. How did they start with a big audacious idea and execute on it? What were the techniques and tools they used to take their businesses to the next level? We want to drill down and understand the building blocks of their business, from their first target audience, to building the tech, to acquiring customers, making partnerships, and expanding internationally. Our first guest is MoneyLion's founder and CEO, Dee Choubey. MoneyLion's roots were in personal finance management, and the firm rode its early success into an expansion into general banking services. Dee discusses how he determined what would be his first initial target audience and where the opportunity was to serve them. We talk about how important this early focus is and how it helps serve the business as it grows. MoneyLion's Dee Choubey is my guest today on the Tearsheet podcast.
Hi there. Thanks for having me. My name is Dee Choubey. I'm the founder and CEO of MoneyLion. MoneyLion is a digital bank. We're servicing the hardworking members of our community, really hardworking Americans throughout the United States today.
And before we hop into what MoneyLion is and who your audience is, I'm curious to know how does a banker start up a startup bank?
That's funny you say that. I spent 12 years in investment banking prior to starting MoneyLion, and really I had a front row seat to the evolution of a lot of the different business models, not only here in the United States in consumer finance, but across the world. And what we saw from the early 2000s through the LBO boom in the mid 2000s, which led to the financial crisis, or which at least contributed to the financial crisis. It wasn't just the LBO boom; it was how we were underwriting mortgages and how the incentive structures were aligned. We had one clear observation, and that observation was that the digital transformation that was taking shape in Silicon Valley, in e-commerce, in social media, consumers were really learning how to interact with their digital lives. Consumers were getting very comfortable with sharing online. They were getting comfortable with transacting online. If you think about 2019, you don't have to go that far back to remember that in 2009, 2008, putting your social security number on a web form was a big deal, and most Americans didn't do it. But e-commerce and what happened with the transformation around Google, Facebook, LinkedIn, Twitter, educated consumers. And one of the insights that we had sitting inside the largest banks, Citi, Goldman Sachs, Barclays, was that transformation was going to come to banking, and we wanted to have a role in creating the digital platform of the future, the customer acquisition platform of the future, and more importantly, the customer retention platform of the future. So we always wanted to think about, we always had this idea of really thinking about what does a bank look like 10 years, 20 years, 30 years from now. And we always had this idea that the bank should be a lifestyle play, that it shouldn't be just a rote bank account or a rote ability to offer an investment product or a lending product, but rather it should be a community. It should be where someone belongs to, and ultimately something that allows them to spend less time on finances because they're learning, they're getting taught by the data of the community. And really the confluence of a lot of the API economy, the data that now we can leverage, really started to take place in the early 2010s. And that's really the vantage point we had when we thought about why leave the incumbent institutions and really start it from scratch.
Great. So taking that as context, like when you started thinking about starting MoneyLion, um, who was the end target? Like who did you think at that point was the end target? Why target them?
Yeah, so we wanted to target consumers that were otherwise unbankable or underbanked by the existing ecosystem. Now, when we say unbanked or underbanked, we don't just mean segments of the population that just don't have a lot of earning capabilities. One of the big insights that we have learned is that financial stress does not discriminate. You can
Hmm.
be a millionaire in New York or San Francisco and still be under severe financial stress, and you could still be severely underbanked. You may have a very high earning capability, but there may be something in your past that is just not congruent with how a bank underwrites a credit product or investing product, or how they holistically look at you. So we always wanted to be a player in the data space. We wanted to aggregate a lot of data. One of the strengths of the company really was some of my co-founders who were all analytics focused. Our CTO was a preeminent expert in machine learning. He'd been doing it since the 1990s. He actually built a startup before this where they were doing simulations, war simulations for the government in the Middle East, and it was oft used. And really, we wanted to bring that capability of using data science to untangle financial stress, not just for people who had low earnings, but even for people that had the capability of really earning a lot of money, but still were left out of traditional banking services. So we wanted to really use the data of behavior to make underwriting decisions. But what we realized at the beginning was just being a data player was not enough. You had to actually offer the customer a direct to customer product. So in our case, we started off by using writing loans as a beachhead to building the digital bank. And our ability to use untraditional data sources and bank transaction data, behavior data, and what's happening in the recent history of this consumer from a velocity perspective to underwrite credit allowed us to target a large swath of the American population that was financially stressed. And if you remember 2011, 2012, 2013, folks had foreclosures on their history, high ability to pay, but the bank still would not be able to offer products to them because they were relying on a FICO score that said, hey, 4 years ago or 5 years ago, this consumer may have had a problem with a credit card or an auto loan or a mortgage. But as we got out of that black swan event, people's balance sheets and P&Ls were recovering. And our ability to really capture that user base that was financially stressed but recovering allowed us to build a large user base that you see today.
That's interesting, and I assume over time there might have been pressure to expand your focus. Have you expanded your focus, or how did you fight against sort of that urge to sort of be more inclusive?
So all of our expansion, whether it be segments, whether it be features, whether it be surrounding the consumer with so much value that they don't leave our ecosystem, all comes down to what we see in our data. We see the need for certain financial products from certain segments. And when we see a critical mass of it, we will think about expanding and offering that solution either through third parties and in extreme situations ourselves. So if you look at our evolution for the first 3 years, we were, monoline lending company, and we really learned how to lend money, how to convince consumers to pay us back, and we really built a very scaled lending operations. 3 years into the business, we started really integrating financial advice and financial planning to the consumers that we were lending to. And we were, the big insight though from the data that we got was consumers are generally okay 9 months out of the year. They make a little bit more than they spend. And in those months, if they're able to put some dollars away, whether it is as little as $50, as much as $500 or $1,000, they actually create collateral for us to be able to lend to them at even lower rates in those 3 months when financial shocks occur in the American household. And they invariably do, and the data will suggest that It's usually around the holidays or sometimes over the summer that American families go through that massive financial stress, that shock. And that's really where we wanted to make sure that our credit products were available throughout the year to these consumers. But that's, that the data really has guided how we have added orthogonal products to our feature set. And in doing so, the customer segment has expanded. So when we launched our financial planning and our investment management capabilities, it was really geared towards the segment that I just mentioned, the consumer that has 9 months of decent financial performance, but 3 months of massive deficits. But we realized that in doing so, one of the unintended consequences was we started attracting a segment that was just coming for investing. And we started learning from their behavior. And a year later, we realized, okay, the confluence of these two segments really needs a next generation digital banking solution where we can eliminate the business model of inertia. We were seeing in the aggregate data, the average consumer was spending $97 every 6 months in bank fees, whether it be NSF fees, overdraft fees, commission fees, and just sort of the risk premium that the banks charge, the incumbent banks charge for offering their branch networks. If you calculate the top 10 banks in any 12 months and their 10Ks about for how much revenue they've generated from NSF fees, commission fees, overdraft fees, that's in the hundreds of billions of dollars for just the top 10 banks. And if you tax effect that and apply the forward earnings multiple on that, you can just see how much of bank market cap is supported by this fee stream. And we believe that that fee stream is worth targeting with better technology, lower cost of service, more transparency, more use of machine learning to these consumers. And really, that's how the business has evolved over time.
And I guess how important, looking in retrospect, how important was the choice of each specific audience as you've grown to your success today?
I think really focusing on financial stress has been, the theme that has, really been consistent over the years. If you're in the top 1% and your balance sheet and your ability to earn are very, very robust, we're a fun and good and sleek solution for you, but you probably have many other options. But for the customer, and 90 million Americans self-identify as being financially stressed, so we think the audience is large. But if you're someone who has anything that's variable, whether it's your savings that are variable, your savings rate, sometimes you save, sometimes you don't, we're the solution for that customer. If your paycheck is variable, one of the segments that we do really well with are anyone in the gig economy, anyone that is working many jobs. And we're seeing that in California, for instance, there are freelancers that have an incredibly high earning capability. We are the right solution for them because the banks, because the variability for them really doesn't fit inside a bank. Uber drivers, Lyft drivers, freelancers, guild workers, union workers. These are really our target audience from a customer base perspective. And you'll also see, high earners as segments as well that are just looking for a better, more integrated platform where the bank account is built on the same technology set as the investing capability and the borrowing capability. So while the segments are diverse, it's really still built for the segment of customers that have some variability in either their savings rate or in their earning capability.
So I guess in the remaining time we have, I'm curious, what do you think, Dee, that you've done well at MoneyLion that has helped you either at a product or marketing level get closer to exactly the target audience that you've described?
Yeah, that's a great question. I think we're always focused on this idea that getting paid and saving for those 3 months where consumers are going to have that deficit creates a a big mental mind share on many of our members, and just kind of really understanding that insight around helping around Thursday and Friday, helping in those weeks when we're not getting paid from a credit perspective, and then really having a conversation around literacy, around what should you be doing, in your 20s to get better in your 30s, and in your 30s to get better in your 40s, and so on and so forth, has resonated that, folks have a very complex relationship with their financial lives. Oftentimes, they don't want to interact with it because sometimes it's not good news. So, from a product perspective, we have incorporated probably every single theory from behavioral economics to really affect behavior change from a interaction perspective. And we're seeing from outcomes that MoneyLion members, from when they start to when they finish, increase their credit score by 40 points. They become wealthier. Their savings rate gets higher. And it's around those ideas and those principles and those themes of financial stress that we really coalesce our product strategy of acquiring, retaining, delivering, and retaining the best value proposition that the middle income household has out there today.
And what about from a messaging point of view? Either from the language on the site or some of the outbound marketing, has that? Can you give some examples of how
Sure.
that focus on that audience has impacted your
Yeah,
community?
the message is all about community. And the message that we want to give to our members is that you're not in it alone. Americans, our CMO does a great job talking about this from a messaging perspective, but Americans have never worked harder. If you think about the past generations, the ones that have built our infrastructure are the tallest towers in America, the longest bridges. If you look at that generation, we're working harder than even them, and we're working longer in our lives. So the messaging for our members is all around, you're not in it alone. There's a very powerful MoneyLion community that's going to help you every day, whether that's with smoothing your income through credit products, or just getting you on a path to really thinking about retirement or your goals. It's the communities, and the community contributes. Their biggest contribution is their data. They will opt in to anonymize their spending data, their saving data, their investing data into insights that, hey, 30-year-olds are doing this in New York, 40-year-olds are behaving in a certain way in Ohio. Here are 4 steps you can do to really right size your financial life and your financial balance sheet to be more like these these best members of our community. And here are 4 tips, and here are 4 options for us to help. That message of community is really resonating, and that's really why we're seeing success in our user growth.